Good morning, folks. Wishing you all a very, very happy Diwali. We're getting into the festival weekend, and thankfully, the market's also been more alive than the previous weeks. We had touched a many month low, and with a little bit of cheer coming in, I think largely because of improved political situation, and not to forget, FIIs pumping in about 3,000 crores into the equity market. The sentiment is a little better, setting the stage for Diwali. And of course, the biggest one that I have not spoken about that set the stage for a good Diwali was the huge jump in gold and silver prices, right? And we've been talking about it in the earlier weekly wraps also. So it's all over the headlines. I don't think we have to get into it again. And this time, this week, folks, we are going to have it a little different. I have some of my team members here with me today. Okay. And And so with the festive mood in, I thought we'll have a slightly different format. We're going to have a discussion on some of the topics that I'm going to be talking about. To kick off the discussion is a nice article, a nice piece of research in ET Wealth on over diversification or diversification in general. Okay, so this is a topic that has been surfacing every now and then, but I don't think enough has been said about this topic because we still come across so many portfolios that are irrationally diversified or irrationally constructed. Okay, so what is it that the author Yasmin Hussain is saying here? Essentially saying that investors tend to have 20, 25 or more funds in their portfolio, and that is not great for performance. And why is it not great for performance? Because this essentially brings down your return to average or below average. So any notions of aiming for outperformance cannot happen if you are irrationally diversified. Okay, I will use irrationally diversified rather than over diversification because you can also have a concentration issue when you're constructing your portfolio. So you have two ends of the spectrum. You have concentration and you have over diversification. And how do we get to the middle path? So here we will not really touch upon the issue of asset diversification, and I'd rather jump straight into that part of the article which talks about having too many equity funds. Okay, so Yasmin really points out that you can have many funds with similar holdings, which they call overlap, and points out a few funds where the overlap is even 40-45% and more overlap between the portfolios. And then why ever should you have all these funds? Because they have the same holdings. Okay, and three large cap funds which are shown as a case in point have large overlap and very, very similar returns. Okay. So you need not have three large cap funds or three similar large cap funds. You'd rather have large cap funds with different holding pattern. Okay, the question comes with just a different holding pattern. Do you need to have it, or does one need to go deeper? So we'll go into it. Vishnu, you had a point on diversification.
Yeah. Practically speaking, when does over diversification become evident in a portfolio?
I think if you're going to be tracking your returns over time, you'll probably see that as a portfolio of your equity funds, is the return tending to the average. So if you have the universe of funds or the benchmark, is your return tending to the average or tending to the benchmark and not trying to outdo it? That is one signal when you can make out. It can also happen that if you are over diversified, you could even underperform the benchmark because you're going to be having a number of funds who are underperformers. And if you tend to have more of them, then you will have either underperformance of the benchmark or tending to the average, but not getting into the top quartile or the top two quartiles. That is a clear sign of over diversification plus the number of count. Okay, you could have three bad performers. That doesn't mean over diversification. Okay, it could be a concentration issue also into a particular style. Okay. So when it comes to style, so diversification also means having different styles in your portfolio. You could have value, you could have growth, you could have momentum, you could have quality. Okay. And if you have 5 funds and all the 5 are of the growth variety, then you do not have diversification. Or if you have all 5 of the momentum variety, you are not going to have diversification. When the markets favor that style, it will do well. When the markets are not favoring that style, it could do very bad. So diversification is to have funds with different kinds of portfolios, funds with different kind of styles, both, and of course different asset classes, asset caps, large cap, mid cap, small cap, flexi cap, multi cap. This also could help in diversifying your portfolio. The Tuesday's Mint has a nice article by Siddharth Pai, and the title goes, AI Frenzy. Don't be caught off guard if the bubble bursts. So we haven't heard we've not come across the term bubble for quite some time. And suddenly over the last few months, there are a lot of concerns being raised. Are we in an artificial intelligence bubble? And Siddharth answers some pretty tough questions in this. But of course, it does start off with the warnings coming in from central bank leaders. It started with the Bank of England's head talking about a repeat of what Greenspan said about irrational exuberance before the global financial crisis. And he cautions that possibly AI company valuations are dangerously stretched. And that's, central bank speak for B. You got to be very cautious, have a look at the fundamentals, okay? And then JP Morgan's CEO, Jamie Dimon, also says, the probability of a bust is probably 3 times what has been priced in. Okay, so you also have the head of the IMF last week saying that there's possibly a bubble happening in some sectors. So you have 3 institutional heads talking about a bubble, and some of them talking about US valuations in general, and some of them going straight to AI and saying, is there a bubble there? So we need to differentiate between the industry and the technology itself and its valuation. The bubble could be in the valuation and not in the industry itself, because artificial intelligence by itself is definitely going to have a structural shift impact on everything that we do. So there does not seem to be a bubble in the technology, but the way that the technology is being priced is where we need to be very cautious. Some of the signals of this bubble comes also in the way the way funds have been moving between companies involved in artificial intelligence. The recent transactions between OpenAI and NVIDIA, okay, how NVIDIA is funding OpenAI and OpenAI is using those funds in turn to buy NVIDIA's chips. So, I mean, that is circular. It cannot be anything else. And such transactions happening in between other companies also who are cash rich. And this makes us, be very, very cautious. Okay? So you did have the dot-com bust and the boom, and that dot-com was a bubble, again in terms of valuations, not in terms of technology. When I say dot-com, it was the internet era, beginning of the internet era. And today internet is very much fundamental to the way we work. And it need not be just eyeballs as it was in the dot-com. We have progressed way beyond on how to use the internet. So AI also, we are going to be using it in a lot of deep manners across. And yes, it could result in a lot of job losses and new jobs being found. We'll come back to that later. So here Siddharth says, the line between a growth stock and an overpriced one is unclear, but expectations define it. So even given these valuations, even 1 quarter of being below expectation could bring the stock price down, like what happened in the case of Oracle recently. So it's not just a fine pricing, we are overpricing the stock today. And let us be very, very careful. Then we also need to be clear about when we are investing in AI, are we investing in companies that are using AI? Are we investing in companies that are building AI, either in terms of software or hardware? We need to be very clear, okay? What could be sustainable are those that are actually creating tangible products that use AI. Okay, so for example, Nvidia is producing tangible hard products in the form of chips. Okay, valuation though is a different concern altogether in these cases. Okay, so you should not be abandoning AI, but be very careful about what kind of AI you are going to be investing in and at what valuation. Do not throw caution to the winds, as one would say. Okay. Shamli, you had something on AI, right?
Yeah. So there are certain AI platforms which also makes investment decisions and investors rely onto it. How is it different from what we do, and what could be the risk when somebody is over relying on AI for making an investment decision?
All right. So you have different kind of platforms for artificial intelligence. Some are geared to use data and some are not geared to use data. If you happen to be using a platform that is not geared to use data, you could get wrong output. You need to be very careful. As a layman, you may not be clear as to which engine to use and how skillful you can be in using that engine. Even today, if I am using any of the AI engines, I tend to try and reconfirm the data that comes out. And I have found errors in the data that comes out. And if you challenge the engine back, it will correct. So how often are you going to be challenging the data? Are you going to even be aware that the data has to be challenged? So I think we are in an experimental mode, but things are improving so quickly. There would be very shortly a time when you can clearly rely on the output from an AI engine. And if it is geared to data, if it's geared to complex financial matters, then I think one would be able to rely on AI engines to some extent. But I would say that the reliance can happen if you're very sharp and you're self-aware. Okay, because when a human tends to advise on investments, we take into account so many issues, right from your risk appetite, your risk tolerance, to your present situation in your life cycle, your assets, your liabilities, your fears, your maturity in the industry. Okay, so as an advisor, we take those into question, but as an investor, you may not realize that there are so many variables at play. That is where the difference comes in and the reliability comes in on using AI. So we are speaking about AI bubbles and some of the central bankers giving warnings, right? And then we also have reports in the next day's Mint saying Wall Street is firing on all cylinders, fueled by deals and trading. So we've had the last week filled with the large banks in the US coming out with the results, and all of them have beaten expectations. And just to give you an idea of scale, which I love to do, JP Morgan is on track to make a 50 billion annual profit this year. $50 billion from one not very large American institution. That's like 5 times Reliance Industries profit made by one bank. So the scale of some of these institutions never ceases to amaze me, and I'm not even going into the kind of profits of Mag 7 have been making. Right? So this makes one thing clear. If you're looking at global diversification, you just cannot miss America. Okay? You may not want to invest much of it today because of valuations, but sooner or later you will need to be having a slice of the American capital markets if you want to take part in that kind of scale. So all Goldman, JP Morgan, Citi, Wells Fargo, all have come out with very good numbers, and largely this is because of renewed surge in deal making. Mergers and acquisitions is where these banks earn much of their fee from. And again, in terms of scale, to give you an idea, this year has also seen the largest leveraged buyout to date. So there's a company called Electronic Arts, which is a leading video game maker, a listed video game maker. They decided to go private, get delisted and go private. So Goldman funded them $20 billion to buy back their stock and go private. So this company is willing to borrow 20 billion just to get unlisted. So that says a lot about what they felt their public valuation was, and that they could be better off they were unlisted. And $20 billion to get delisted is again speaking about the kind of fizz that is happening in global markets. Okay, so on one side we have uncertainty, and on one side we are cribbing about what could be the role of tariffs, and on the other side we see this huge level of deal making happening. At the same time, the US is seeing, possibly after GFC, the largest number of large companies going bankrupt. Okay. So we have a mix of signals, and this kind of a mix I would rather read caution into it. Okay. So JP Morgan's trading revenue grows 25%, and Goldman revenue is up 12% on trading. Okay. So Goldman's CEO Solomon says, taking a step back, there is no question there's a fair amount of investor exuberance at the moment. So people like to be very cautious in the terms they use, but you have the CEOs and heads of large banks talking about caution. I think investors should be very careful. By the way, US has seen the largest inflow into ETFs so far. Okay. And people are moving away from actively managed funds to ETFs, even in the US. And I think this is a topic that we'll take up in our next weekly wrap on how Indian funds have been outperforming or underperforming the benchmark. On Tuesday, the Fed's chair Powell made an unusual statement. He said probably we are at the end of the balance sheet tightening. Markets immediately celebrated because they said if we are at the end of the tightening cycle, that what follows would be loosening. And I think markets should sort of bear in mind that between tightening and loosening there can be a pause. Okay, so but if there is if the Fed decides to expand balance sheet again, getting into a quantitative easing mode, I think risk assets will shoot up. Okay, so let's hope that remains under control. Talking about risk assets, after a long time I'm seeing a double page article about Bitcoin, and the headline says, can Bitcoin wear gold's crown? That's a big extrapolation of the, given the entire argument about debasement of US currency, there has been a renewed interest in cryptocurrency, and Bitcoin is the largest of them, followed by Ethereum, and both have been shooting up in values. The point is, can Bitcoin be considered a safe investment? We all know that cryptocurrency, which is not backed by central banks, do not have any kind of an asset back. It is purely based on supply and demand. Just because the supply of Bitcoin is constrained and there's a large demand, the price is shooting up. Can it be an alternate currency? It can be an alternate currency, but it will not have the backing of governments. Okay, so you see what happens is Bitcoin becomes a private currency, unregulated, and no government would like to have a currency which is not in their control. So we need to be thinking in those lines also. So eventually you may be having central backed digital currency which could take center stage. It may not be too far away. It could be happen very in the next few years itself, maybe in the next 5 years itself, you'll be seeing more of CBDC happening. But whether Bitcoin can take the place of gold, I don't know. Gold is a store of value. Bitcoin has no asset value apart from demand and supply. Some things that gold also shares also based on demand and supply. But when there's a crisis, how do these assets behave? Right? Which is what Hiloni, you were also asking about. When there's a crisis, what happens? So whenever we see a crisis in the market, we find all risk assets following. If crypto is supposed to be behaving differently, it's not showing any evidence of that. When equity markets fall, crypto falls equally. If there's a war, crypto falls along with the other risk assets. So I don't think it is giving you any downside protection like gold does. So just in the last 1 year, we have seen Bitcoin move from $11,000 to almost $62,000. And then when we had the tariff-based uncertainty, it fell from 60 to almost $25,000. And from 25, we have seen it go to $115,000, all in a year's time.
It's a very volatile asset in the sense you cannot rely on it as much as you can rely on gold.
I think so. Doesn't seem to. If you have a asset price that is so volatile within a short time frame, and if you want something which is uncorrelated, then Bitcoin is not it. Okay, so you want safety, you want low correlation. So also this article gives you the correlation between Bitcoin and others. So Bitcoin and Ethereum obviously have a high correlation of 79%. So with the S&P 500, it says that correlation is only 10%, okay, which means to say low correlation. But if you're looking at the behavior in the last 1 year, whenever, yes, the S&P 500 and the Nasdaq did not fall as much during the tariff tantrums, but you had Bitcoin fall as much. Okay, so yes, it could be an asset in your portfolio with a broadly lower correlation to other assets, but I don't think it can take the place of gold.
On the S&P 500 correlation, even though the correlation is lesser, the volatility is much more. That
Yes.
could be a case.
Yes.
So you cannot rely on it.
Yes, that's an important point. The correlation may be low, but it has its own independent volatility, which sometimes can be stomach turning, and you need to be able to survive that. Okay. That's about Bitcoin. And okay, and this shows an interesting bit of news which many of us are not aware. Mutual funds units can be gifted. Okay, so we do know that if the units are in a demat form, they can be gifted or transferred to another demat account. But even non-demat mutual fund units can now be gifted. So if a parent wants to gift to the children, or a grandparent wants to gift to a grandchild, it's possible. It is not considered a sale and purchase. So it's treated like any other gift. Okay? If it's a close relative or a blood relative, it is not taxed in the hands of the receiver. It will only be taxed at the time of sale. Okay, and the acquisition price at time of sale is the acquisition price of what the donor acquired it. Okay, so this is it gives a lot of flexibility if you are doing financial planning and you are doing long range planning, where investors would like to keep some units apart for gifting to their children or grandchildren, etc. Okay, at the same time retaining control over it. Yes, this is an interesting one. The entire week's papers, at least in the business papers, have been filled with a lot of articles about Joel Mokyr. I hope I've got it right in pronunciation. He's one of the Nobel Prize winners for economics this year. And so here we have an article by Alison Schreiger talking about the importance of Joel's contribution to economics. So the center point of his theory is that without innovation, you cannot have growth. Innovation is central to economic growth. And which are the kind of economies that can grow? They can grow only if they have innovation as somewhere in the center piece. Okay, so she's very nicely made it into 4-5 points. Okay, the first point: economic growth is often resisted. So she says growth has always been critical to economic prosperity. It is why people live longer and lead more comfortable lives that are free from the drudgery of hard labor. But it is often resisted. And she speaks about the time of the Industrial Revolution, where from manual labor, machines came into being, large factories were built, mass production was invented, or it became the beginning of mass production. And it was very difficult for factories to get labor. because people did not want to go and work in factories. They were not used to working under a boss. You had people, the society was such that they were working individually. And suddenly you had to go work at within a certain time, maintain a discipline on time. You had to report to a boss. They were not used to it. And for a long time, I believe men would not go and work in factories. It was only women and children who would go work in factories. So that was, I think, one of the inflection points as far as society is concerned. Okay, and people forgot their entrepreneurial DNA and became part of larger workforces. Okay.
Then same thing can happen when the AI is being adopted. Resistance.
There is even now. When computers were being adopted, there was a large resistance. Okay, and I do remember the time when my dad, who was a chairman of a large bank at that point of time, he wanted to introduce computerization. At that point of time, they didn't have computers, and unions were resisting it. They did not, because they were scared that their jobs would be lost. This was like 1980. Okay, and now we know that actually the computerization has spawned so many jobs. It has been the reason for so many jobs, and the country's growth and prosperity has been based on computerization. Is it not? So at that time, computers had to be brought in sneakily and not called computers. They were called automated ledger machines, so that people would not get scared of it. So you need to persist with it, and the benefits and growth always comes later. So if you are worried about AI replacing people now, there would be a time period where there would be pain, but then it would only help prosperity. And which is also a point made by Joel here, that growth is unpredictable. New innovation destroys jobs, but they also create new ones. It's just that we don't know when the new ones will be created. There will be unpredictability, and that is part of economic growth. Okay. And most often he is very focused on saying growth is actually cultural, and institutions should be enabled for innovation. You cannot have a government or an economy which is so focused on centralized planning. It will never allow innovation to happen. So that is why Europe initially was very good at innovation. They had great economic growth, followed by America, again a hotbed of innovation. Decentralization and independence is important. And I remember I just saw another quote by Joel Biker in the next day's paper saying that to have sustainable growth, you need to have irreverence. So again, cultural. Countries like China, maybe India, give so much importance to what has been done earlier. We may not be innovative enough. You need to have creative destruction.
We're also constrained by our own biases.
Yes, yes. And if there's a tradition, we want to stick to the tradition. We don't want to be breaking the tradition. But to have innovation, breaking tradition is an important part. So which is why he thinks that China is not a sustainable growth story. Because innovation in China is top down, it is forced. It is not in the DNA, it is not cultural. This is what we have from this year's Nobel Prize winner. I think any questions, any points to be made from anyone?
So I have a question on US banks.
Yeah, Kushal.
So, how are the US banks, structured differently compared to, Indian banks?
Yeah, a good one. So we can easily consider US banks as well deep in the maturity cycle. Okay, and Indian banks are not yet at that level. Okay, it's all about disintermediation. So in the US, banks earn more out of deal making and investment banking, fee-based revenue and trading revenue rather than just lending. Okay, whereas Indian banks still earn a lot from credit itself. Okay, and the way you see credit also differs. So in the case of Indian banks, the Indian banks lend money and then wait for the money to be paid back and then recycle the money into new credit. Whereas in the US and even much of Europe, what happens is banks serve as originators of credit. They lend, they create home loans, they create education loans or student loans or retail loans, and as soon as they created, a year or two down the line, it is sold off. It is packaged and sold off as receivables, securitized receivables. And what they make is a 1 or 2% margin there. So the turnover is higher. The moment they securitize, they go create and originate new loans. So the market is much deeper for bonds because of large insurance companies, large pension companies, large sovereign funds, and all these go to feed their appetite. And I think as we grow our economy, as financialization becomes more rampant, as we are in that trend, we will eventually go there. Banks will learn to securitize quickly because there's new business to be done. Today our credit growth is languishing at 10-11%. The banks are hungry for credit. There's not enough loans for them to lend to. And Indian companies only of late have learned, the large ones, to go to the market directly. So they are issuing bonds and directly borrowing from the market rather than going to banks. These are the very large, well-rated and trusted companies. This is something that is a core feature of the American capital markets and even the developed capital markets. The large borrowers go to the market directly. They don't go to the banks. Banks are left to do retail lending. Banks are left to do securitization. Banks are left to do fee-based income. And I think even we will eventually go there. We will probably leapfrog because we have fintech to contend with. So you will be faced with disintermediation at a much quicker pace than what the US has faced. The complexion of banks 5 years down the line could be very different from what we are seeing today. That's all, folks. Wishing you a very happy Diwali again. Have a great weekend. Good day.